One of the major questions that I receive and that I hear on my radio program, that I get emailed to me, or the dialogue between different people, is this question, and I bet you it's a question that you've thought in the back of your own mind. And that is, will your money last you in retirement? We look around and we see so many different instances and illustrations of where money doesn't last. I was just talking to one of my staff members about many years ago. I heard the story of Mike Tyson. And we all know Mike Tyson, very successful boxer, very wonderful athlete. I mean, the guy is just a tremendous boxer. And he was at the top of his game. He was making so much money, he didn't know what to do with it all. And he bought the most beautiful mansion, had it built up, and it was exquisite. It was more than you and I could probably ever live in a lifetime. Like, I don't know how many rooms were in that mansion of his. It was gorgeous. It was beautiful. And within a few short years, he ended up losing the mansion because he was broke. The question, will my money last, is really dependent upon many different factors. I mean, one of the more simple ones could be, well, you tell me how long you're going to live, right? Because if you're going to have a short life expectancy and you die at the age of 65, then yes, chances are your money's going to last. If you're going to live to 107, totally different set of circumstances. But I will suggest to you that it depends upon your life expectancy. It depends upon your frugality. It depends upon how well managed your money is when it's in your bank account and in your wallet. Many years ago, I went to a Dave Ramsey, meeting or conference. And it was funny because he said that within every married couple, there's always two different personalities. One is the nerd, the geek. And that's the one that's, very frugal and pays attention to the numbers and the spreadsheeter and that sort of thing. They're very careful. And then the other one is the free spirit. That's the big spender, right? I don't know that that's true in every couple. I've met plenty of, outliers to that little illustration that there's two different people in the household. But the reality is that who's going to be the predominant force within that relationship? Because I have seen spouses coerce the other spouse to save more money. I've seen spouses coerce the other spouse to spend more money. Kind of depends. But one of the biggest determining factors is how you invest your money. That's going to be a factor that will indeed have an impact on whether your money is going to last. Let me give you an example. You see, most of the individual investors today that have been diligent and they've saved in their 401ks and they've personally saved and they've built up money and they've tried to be able to build this nest egg that they knew that they were going to need for retirement, most of them have been pretty diligent. And they've gone through the dollar cost averaging. They have been able to buy a lot more shares when the market was going down. And that was extremely helpful to them because they were buying things when they were on sale. But when they get to that age in which they're going to retire, most investors today, most workers today aren't lucky enough to have a pension. Most of them aren't lucky enough to have an income producing set of real estate like rental properties or farm ground or something of that nature. And so the big conundrum that they're in is trying to determine how they get income from what they've saved. Now, I know that there's solutions out there that insurance agents would try to sell where they say, well, we'll put your money into this thing called an annuity, and this annuity will pay you income for the rest of your life. And you know what? There is some real legitimate contracts out there that do well. But unfortunately, most of the time, they either have very low performance or they have extremely high cost. I don't like either one of those options. What we need to do is we need to discover this equation. And the equation is TR equals I plus G. Write that down. TR equals I plus G. The equation is simple. It is total return equals income plus growth. You see, so often today investors are trying to get income by selling growth. But you and I both know, if we go back to the turn of the century, when the stock market corrects, it doesn't necessarily just last 6 weeks like we saw in February and March of 2020 with the coronavirus. Most of the time, those major corrections can last for months, sometimes years. The first major correction after the tech bubble burst lasted for 3 years. Shucks, the Great Recession lasted for 2.5. And you see, even though you say, well, that seems relatively short term in the grand scheme of things, though it does, the problem is that if the stock market's not going up, it's going down. And you're having to sell your shares of your mutual funds. You're having to sell the shares of your index funds. Your dividends are not sufficient enough to give you the income that you need. So you're having to sell and cannibalize your principal to get what you do need to survive in retirement. As the share price continues to drop and go down, you're having to sell more and more and more, and you're cannibalizing your principal at a faster and faster rate. So will your money last? Well, in a situation like that, it's not very likely. There's one other factor that's going to come into play, and that is going to be the cost of goods and services, the cost of living. I don't know about you, but when I go to the grocery store and I walk out with maybe 2-3 sacks of groceries, and that just cost me $50, to my mind, that doesn't even compute. I just don't get that. How is it that food costs so much today? And if you want to eat healthier, it seems to cost you even more. So between the cost of living, between the volatility of the stock market, between life expectancy, you have a real challenge on your hand. So is there a plausible solution? Is there something that you could start to implement that is going to give you a greater chance, a greater probability of being able to make certain that your money does last you all throughout retirement? And I believe that the answer is yes. But here's what you've got to do. You've got to go back to old-fashioned technology to do it. You see, the people of the Great Depression from 1929 to 1954, that generation knew what it was like to watch the stock market drop 93%. The worst correction we've seen in our generation is 63%. Imagine 93% of what you've got in retirement just seemingly to disappear. And they learned a valuable lesson about money. They learned if their money was going to last them, they had to protect the principal at all costs. And they had to be able to have that principal there to dip into if they needed it, but otherwise they were going to live off from the interest and the dividends. So let's go back to that equation I just taught you. TR equals I plus G. What this represents is that when you're young, when you're working, when you're in the accumulation phase of your life, you need to most definitely be focusing on the G. You need to be taking the risk. You need to be dollar cost averaging. You need to be being aggressive within your own investment strategies. Even if you feel that, gosh, this is probably a little more risk than I would want, realize you're not going to be needing that money when you're 30 for another 30 years potentially. When you're 40, another 20. When you're 50, maybe another 10 to 15. So what can you do when you do get to this point where you're about to make the transition from the accumulation phase to the distribution phase? It is begin to focus less on the G and begin focusing more on the I. And what do I mean by that? Focusing on fixed income instruments, fixed income investments. Back in the day, people would say, I own stocks and I own bonds. Why? Because the stocks represented the G, the bonds represented the I. Now, the bonds are just one example in an entire universe of fixed income generating investments that a person can make. But the reason that that generation focused more heavily on the I, and the reason that that generation was one of the most wealthy generations, was because they learned how to leverage their principal to continually make them money through interest and dividends. They focused on the I. And as long as that principle was there, as long as they were using the interest and the dividends to live, the principle was continually staying there, continually generating, like a renewable energy, the income that they needed to live. So your question is a valid one. Your question is one of great concern, not only for you, but for your spouse and for your family and for the rest of the retirees in this country. But it will require you to begin to implement and open your mind to investing for the I, and exploring what those tools are and understanding the benefits of what they can bring to the table for you so that you can have more income than you ever imagined possible that is sustainable and lasting all throughout your retirement. Remember, it's up to you to make today a great day. Thanks so much for watching.